Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap that we do each and every night here on the membership side of our blog. So as always, those of you who are new joining us, welcome. We do this video every night to go over our opening and closing or adjusting trades that we have. And then all of you out there who are watching on YouTube, you get this video about 7 to 10 days after we publish it just for our members. So you can't take advantage of any of these trades. Obviously can't take advantage of the closing trades because they're gone. But you usually can't take advantage of any of the opening trades because it's just too long of a waiting period between the time that we send out the alerts to our members and publish this video and the time you guys get it. So the only way that you can get these videos is to sign up for a free trial at OptionAlpha.com. And welcome from snowy Virginia. We're supposed to get pounded with a lot of snow, so I'll be in here doing none other than writing new blog posts, which I need to do, and also creating some new content. I'm working on a new ebook that I think everyone will like over the weekend as well. So tonight we had a couple of opening new orders today and just one closing order that ended up being just a roll down in one of our positions on LinkedIn. So let's cover that one first. So the first closing trade that we had was actually just a closeout of a vertical call spread that we had on LinkedIn. Now this is the original position that we had entered on LinkedIn, and we had added this put spread below the market later on. But now that LinkedIn has continued to move lower after earnings and particularly down a pretty big margin today, we actually rolled down our vertical call spread that we had above the market at 230, 235. We closed out this side of the trade for $142 profit per spread. So again, that's per spread that we already closed out and banked that profit. And what we did is we rolled down and reopened a new position. Notice that we matched up the number of contracts we bought versus the number of contracts we sold on the new spread, and also the width of the strikes is exactly the same. So by doing this, we take in more credit and we do not increase the overall risk in the position. So this is exactly what I continue to preach, and we've done this a number of times in this month here in February with earnings coming up, and this is a really good opportunity to start seeing a lot of these examples come through. But by doing this, we closed out this spread at $8 and reopened it with a credit of $65. So opening the new spread at 210, 215 on the call side. Now, likely what we'll probably do is again go back in here either tomorrow or the next day and continue to roll this thing down even further. If we go to the Analyze tab, you can see that the new Iron Condor position that we have for LinkedIn still has a fairly wide margin here at the top, and that's because we have the 205, which starts to dip here, and then we have the 2010 call spread. So likely what we'll do is move this position over, shift it over to the left, and that will create more of a butterfly spread here on LinkedIn. So we'll be kind of all in around the 205 region, and we'll continue to shift that thing down and go inverted if need be if LinkedIn continues to fall over the next couple of days. We have a couple days here, but we are running short on time, so we want to make sure that our adjustments are quick and that we continue to take in credit along the way. All right, so moving on to other opening orders. We had a lot of vertical spreads that we bought, and this was really just an attempt to add more negative delta to our overall portfolio. So you can see that all of these positions that we added here today are all vertical debit put spreads. So the theme among all of them is always with our debit put spreads that we want to be buying these put spreads at about half the width of the strikes. So you'll notice that the width of the strikes here for USO is $2, and we bought this spread for about $1. The width of the strikes here for gold is $1, and we bought it for 50 cents. And the width of the strikes here for the Qs is $2, and we bought that spread for 97 cents, about $1. So the same theme goes and continues through all of this. And what we wanted to do was gain a lot of exposure in some of these broader markets here today to again add more negative delta to our portfolio as the market has continued to run up, namely the Qs and oil and gold. It's only a matter of time before these things start to roll back over. Now you'll notice too that today we also added a lot in April. So April moving out was a really big important deal for us to gain that extra leverage and that extra time. And so I want to go over that in particular with the Qs, why we decided to go with April versus the March contracts, because March are really the next set of contracts. But when you're buying a vertical debit spread, you have to understand that if you get more time and it costs you just a penny or two more, then it is worth that extra time that you have to possibly make a profit, to allow the security to swing to a profit in that time period. So let's take a look at the Qs here, and you'll see exactly why we actually went with the credit spread on the put side. And it's pretty obvious, but the Qs have had a huge run up. We're looking at almost 6-7 days in a row of upward gains for the Qs. So it's conceivable to think at some point now, between now and April expiration, all the way out here, that we will have a dip below this level, and that will allow us an opportunity to quickly take a profit on this trade. Again, this is not a trade, and none of these trades are trades that you want to hold all the way through expiration. We're not selling premium. We're actually buyers of a spread here, so we want to be able to get rid of the spread as quickly as possible and take in a nice little profit. Now, why did we go with the April contracts versus the March contracts? Well, let's go to the actual Q diagram, and I'll show you guys this here below. I'm going to minimize our position down below and just move this down to about 10 strikes each so that you guys can see this. Now, I'm going to enter a sample trade that we had here today. So if I were to enter the same position that we have here in April, which is the 90.88 put vertical spread, and I entered that same position here for March, which only has 37 days, I want to show you guys what the pricing differential here is for that spread. So I'm simply going to right click on the 90s, go over to buy, go over to vertical, and buy those here. And then I'll move this strike down, this 89 that it just defaults to the 88s. Now you'll notice here today that the price of this vertical spread, the March contracts, exactly the same strikes, the 90.88 puts, is priced at 98 cents right now. So it's priced at 98 cents and we paid 97 cents. So it's not bad. It's about evenly priced. So my question to you is this. If you would pay the exact same premium, why not move your position out to 65 days versus 37 days? And it gives you a greater window of opportunity to make money. Now remember, this spread is a debit spread and it's $2 wide. We paid $1 for the spread. So that means at best, we are going to make $1, and at worst, we're going to lose $1. It's a 50-50 bet on the market. Why not give yourself a little bit more time to be right in your position? Giving yourself that extra 30 days is really going to help if we need it. If we see the market really rally here over the next 2 weeks, gives us a lot of time to see a dip back in April and keeps our portfolio a little bit delta negative as the market rallies higher. So hopefully that's really helpful for you guys. That's really what I wanted to drive home. And that's really the same key points that I could go over with GLD and USO. Same logic behind those, why we went for April instead of March. And that's usually what I do with the debit spreads. Give ourselves a little bit more time to be right in this, a little bit more duration in our portfolio. And that obviously is going to increase the chances of our success long term. So again, hopefully you guys enjoy these videos. As always, please add your comments, questions below. Happy trading and enjoy the snow for those of you who are in the Northeast.